All right, grade 12. Today we are looking at the different investment opportunities that is available there for investors, as well as their specific risk factors. All right, so the first type of investment that we're going to look at is investment in fixed property. Okay, and this means you're basically buying a house or a piece of land. All right, so if you are spending your money and you are buying a property, a house, a factory, or a piece of land, this is usually a long-term investment, all right, because you're not going to buy a house today and then sell it again tomorrow, right? So buying property, investing in fixed property is only suitable as a long-term investment. All right, the disadvantage of this is that it requires large fees. Okay, we've spoken already about the fees and the taxes payable when you buy a house or any fixed property. To have that property registered in your name, you have to pay transfer duties. And the transfer duties is calculated as a percentage on the value of the transaction. So obviously the more expensive the property is, the higher the transfer duties is that you are also going to pay. All right, so because of these large fees and the taxes that is payable on these transactions, this is what makes it suitable as a long-term investment, because those fees and taxes is not something that you would like to pay every single year, right? You kind of want to buy the property and then that's it for paying the fees and the taxes, and then you're not going to sell it anytime soon again. Right, now the return on property, on the fixed property, or return on your investment is going to be earned in either the form of rental. So if you buy a property, you buy a house and you rent it out, okay, the rent that you are going to receive, rent income, that will be the return on your property. You are earning an income from your investment. Or if you invest, if you buy a block of flats and you rent out each flat to a different person, that will be the rent income, will be your return on your investment. Right, or on the other hand, you can also get a return on your investment if you sell it and you get a capital gain. All right, but now, as I said, every single time that you buy and sell property, you have to pay the transfer fees and the taxes on the transaction. All right, so when you buy a property for a lower price and you sell it at a higher price and you still make a profit, even after you have paid the transfer fees and the taxes, you still make a profit. That profit is known as a capital gain. Now, your property has gained in value. All right, so the value of your investment is increasing so that when you sell it, you are going to get more money out than what you have paid for it. All right, that is also a return on your investment. Okay, now obviously the location and the size of the property may influence the growth in value over time. The first thing they tell you when you invest in property, when you buy a house, the first thing they tell you is location, location, location. Where the property is situated is vital. Obviously, you want the property to be situated in a better area. All right, the value of your property is protected if the property is situated in an area that is suitable. All right, if you have the big fancy house in a lesser area, the value of your property is not going to increase at all because the area doesn't support that. All right, so it's always, even if you buy a smaller property but in a good area, that would be a better investment than a bigger property in a crappy area. All right, so the way the property is situated, that is going to have a big influence over whether the value of this property is actually going to grow or not. All right, the size of the property, obviously you can also, if you start with a small property to invest in, you can obviously make the size of the property, you can increase the size of the property, right? You can build onto it over time as well, and that will also increase the value of such a property. All right, but again, the most important thing is the location. All right. The risk in terms of these investments over the long term, generally investing in fixed property is a low risk because, as I said, over time, fixed property tends to appreciate in value. The value tends to increase over time. So the chance that you're going to buy at a low price and then sell at an even lower price and lose your money, the chance for that is very, very small. It's never impossible. Nothing is impossible. But it is very small. Now, over the long term, it is a relatively safe investment. Okay, however, the risk will be determined also by economic conditions. It does depend on what is happening in the country. It does happen sometimes that because of what is happening in the country, the value of properties do decrease as well. All right, the chance of that happening is not good. Okay, it's not a big chance, but the chance is always there. So whatever economic conditions is happening in the country, if the country is in a recession, a depression, what's happening with inflation, what is happening with employment, anything like that can also have an influence on the value of your property. Right, the second investment opportunity that we are looking at is your mutual funds or stokvels. Right, this is an informal savings scheme to which a relatively small group of people contribute. All right, to just give you an example, if there's 12 people that contribute to a stokvel, that would mean that every person, every one of the 12 people, every month will make a contribution, 100 Rand, 200 Rand, 500 Rand, 1,000 Rand, it's normally small amounts, right? And then every month of the year, one of the 12 people will get to have everybody's money, for example. Okay, it is an informal savings scheme. Okay, so it's not a formal thing like having a bank account necessarily or buying fixed property. It is an informal savings scheme. And then, as I explained, each member will take a turn to draw from the scheme for their own personal gain. It doesn't matter what they use the money for. So if I am part of a stokvel, every month, January right through to the way December, every month, every person, every one of the 12 people contribute 500 Rand. And then everybody 1 month of the year, let's say my month is June, then in June, I am going to get all 12 people's 500 Rand. All right, so I'm saving basically. I'm every month contributing 500 Rand. In June, I get my bulk amount, I get everybody's money. But remember, then I still have to contribute for the rest of the year so that other people can get their turn in the months after me. All right, so they take turns. How they decide who takes turns, obviously, is up to them. Sometimes they just draw names out of a hat. All right, in this case, there is no return on investment, right? Because in a stokvel, not always do they actually even deposit this money into the bank, right? There's one person that takes control of this, that's the treasurer, and that person will make sure that he gets the contributions of all 12 people, and whoever's turn it is that month, he will just turn over the money to that person. All right, so there's no interest earned, there's no dividends earned. This is just a saving scheme, but there's absolutely no return on investment. Okay, the money doesn't grow. Okay, but it does encourage people to save each month for a specific reason. Okay, lots of people choose to get their turn in the month that it's their birthday, for example. All right, or people want to have their contributions in December so that they can use it to go away on holiday, for example. All right, so instead of saving every month 500, it's basically the same as saving 500 each month, and then in December you're basically getting all the 500 Rands back that you've saved throughout the year. The disadvantage, though, is that it doesn't earn interest. Okay, whereas if you save the money in the bank, you would actually get interest. All right, but people save normally for a specific reason. Okay, it's an easy way to save for a specific reason. All right, should they open a bank account? As I said, mostly in stokvels, they don't necessarily deposit the money into the bank. But if they do choose to open a bank account, obviously there will be banking fees that is applicable. And the banking fees will then be shared by everybody. All right, so it doesn't fall on one person to pay the bank fees, the service fees, and like the withdrawal fees and the ATM fees and whatever. All members will be sharing those banking fees. So per member, it's a low cost of investment. It's not going to cost them a lot because they're sharing those fees between them. All right, stokvels comes in handy in times when it's difficult to get bank loans or for people that don't necessarily qualify to get a bank loan. All right. Obviously, with the new Credit Act now, it has become more difficult for people to have access to credit. All right. So people that might not be as credit worthy or they've been blacklisted or whatever, they find it difficult to get a bank loan. For them, a stokvel is an excellent opportunity to save for that whatever they would like to do with that money. Okay, so they can't borrow the money from the bank, so they get involved in a stokvel instead. And as I mentioned earlier, it is usually managed by a chairman, a treasurer, a person that is chosen by the members of the stokvel that everybody obviously feels that they can trust. It has to be a trustworthy person because this person is responsible for keeping the records and managing the bank account. So this person is responsible for making sure that he gets every member's contribution and that the money is paid out to the relevant person when it is their turn. All right. As I said, it has to be a trustworthy person because this person will have control of the money. All right, so if you don't trust this person and he takes the money and he runs, obviously your money is kind of something of the past, right? Members usually will discuss how the money will be invested. So if there's 12 members in a stokvel, all 12 members will decide what they are going to be doing with the money. Now, if they are going to be depositing the money into a bank account, they obviously will have to discuss that and everybody will have to agree that, okay, we can invest the money into a bank account. And everybody has to agree on the risks. Now, as we said, we're going to look in this lesson now, we are looking at the risks involved in different investment options. So if some members of the stokvel wants to say, oh, no, we want to invest this money in shares, obviously shares is risky. All right, so not everybody is going to be willing to take those risks. Everybody has to agree. Right, the risk involved in a stokvel. Sometimes there's people that start a stokvel that claim to be running a stokvel, but when what they're actually doing is they're actually running an illegal pyramid scheme. And then when it is your turn to receive your payout, you're actually not going to get your money because the cash has actually run out. All right. Pyramid schemes is illegal, but just because it's illegal, it doesn't mean that it doesn't happen. It's still happening all the time, where the people that get into this scheme initially in the beginning, they actually make money out of it, and the people that they sucker into at the end of it, obviously those people is going to lose all of their savings. All right, so it's very important when we get involved in a stokvel that we make absolutely sure that it's not a stokvel or pretending to be a stokvel when actually it's an illegal pyramid scheme. All right, and then obviously if they do open a savings account to keep the money in, keeping your money in the bank is a very safe option. But remember, we did say yesterday that the safer the investment, the lower the return on investment. All right, so depositing this money in a savings account, that makes it very accessible also and not risky at all. But then the interest that they receive is not going to be worthwhile almost. Right, the next investment opportunity that we are studying is the managed portfolio. A managed portfolio is where the investor, you as the person that would like to invest, you are going to instruct a financial institution where obviously you will be represented by a financial advisor to manage your various investments in one portfolio. All right, so the managed portfolio, obviously there's different kinds of investments. This is what, it's not one kind of investment. You have different investments. So you've spread the risk, you've put your money into wherever different kinds of investments, but you have one financial advisor that is going to manage your portfolio. Now, he's in charge of your investments and he can move around your investments without necessarily consulting you. When you appoint him as your financial advisor of the manager of your portfolio, you are basically giving him permission to move around your investments. All right. So if the portfolio doesn't perform as well as expected, that financial advisor can change your investments without asking your permission and without even informing you. All right. So if some of your investments was in shares, for example, if he feels that the share value are not increasing or the dividends is not as good as expected, he can sell your shares and take your money and invest it into a fixed deposit, for example. All right, so this financial advisor, your portfolio manager, basically has control over your investments and he doesn't have to consult you. You give him permission to move your investments around so that you can get the better results. Obviously, the hope is that this person knows what he's doing, right? Okay, the risk is low over a longer period of time. Now, over a longer period of time, obviously short-term fluctuations can be eliminated or it has less of an effect over the long term. So any investment generally is safer over the longer period of time. Right, investments are made in various sectors or various companies. So as I said yesterday, you are not putting all of your eggs in one basket. If you have part of your portfolio, you've made investment in shares, part of your portfolio, you've made savings accounts, part of your portfolio is in government bonds. Obviously, the risk is spread. So that if the share market bottoms out and you lose the money that you've invested in shares, at least you haven't invested all of your money in shares. You still have some money that is invested in a fixed deposit and some money that is invested in government bonds. All right, so because you're making investments in different investment opportunities, different things, different companies, different sectors, different kinds of investments, the risk is spread. And if one of them goes south, obviously the others hopefully will still be okay. And because it is managed by a portfolio manager, again, these people are trained. They know exactly how to study the markets. They know how to predict what is happening in the market. And obviously, they are not all knowing and they can't see into the future. But generally speaking, the portfolio managers, they know what they are doing. All right, money is usually invested in the capital market. Okay, so any unforeseen circumstances can impact negatively on the value of your portfolio over the short term. Yeah, I did say risk is low over the longer period of time, but risks are relatively high in the short term. In the short term, there's always fluctuations as a result of unforeseen circumstances, random things that happens that impacts on the value of your portfolio that nobody could foresee. Random events. It's not something that anybody can predict. And over the short term, that can happen. But if you leave your investments for a longer period of time, obviously the effects of these random effects will flatten out. And over the long term, the effects of these random events will be less. Right, the next investment opportunity is a fixed deposit. Right, making a fixed deposit at a bank is a very conservative method of investment, which means basically that you are depositing your money in a fixed account, in a type of a savings account at a bank, at a financial institution, at a fixed rate, all right, for a specific period, all right. So you are basically going to give your money to the bank, your 5,000 Rand, you're investing that in a fixed deposit. You are basically putting that 5,000 Rand in a savings account at the bank for 5 years at a fixed interest rate. All right, it's a very safe method, very conservative method. All right, so after the 5 years, you are obviously then going to get your principal amount as well as your interest back. All right, the drawback of a fixed deposit is that money cannot be withdrawn or added during the period of the deposit. So if you have deposited 5,000 Rand for 5 years, there is no way on God's earth that you are going to be able to withdraw any of that money before the 5 years are over. And you are also not able to add, right? If you have another 2,000 Rand that you would like to invest, you will have to make a new fixed deposit. You cannot add it to the amount already invested. Now, the amount that you invest is fixed at the beginning. The period of the investment is fixed. The interest rate that you are going to be earning is fixed. All right, so when you make a fixed deposit, you have to be absolutely 100% certain that you are not going to need that money before that 5 years are over, right? You can literally go to the bank and plead on your hands and knees. They will not release your money until after that 5 years are over. So before you put that money into a fixed deposit, you have to be absolutely sure that you are not going to need that money before that 5 years is over. In terms of the risk is extremely low, right? The only risk there is that the bank might fail. And in South Africa, that doesn't happen very often. Okay, we've had bank failures before where people actually lose their money, but generally speaking, saving a bank that is in financial distress is in the interest of financial stability in the country. So the Reserve Bank normally steps in and saves the bank, like they did with African Bank not so long ago. All right. So if you make a fixed deposit, you are almost 100% certain that you are going to get your money back with interest. Right, also it can be upside or downside, but the interest rate is fixed. All right, so obviously this can be a good thing if the market, obviously interest rates will fluctuate. At the moment, as a result of the coronavirus, the Reserve Bank has now, in the question of a short amount of time, they've taken interest rates down by 2% in less than 2 months. All right, so obviously if interest rates fall, if you owe money, that's a good thing. Your repayment becomes less. But as an investor, if the interest rates comes down, like what is happening in South Africa now, that means that you are earning less interest. Okay, so your return on the investment is getting less and less. But with a fixed deposit, your interest rate is fixed. So even if the interest rate of the country is decreasing, your interest is fixed and you are still going to earn your higher interest rate even if the country's interest rates are falling. So the rate of interest that you are receiving is not affected by any market fluctuations. It is a certain thing. You know how much interest you are going to be earning over the next 5 years. Right, the next investment opportunity is a 32 days notice account. Okay, this is basically a savings account. So again, money is invested at a bank, at a financial institution at a fixed rate. But in this case, you can make withdrawals provided that you give the bank 32 days notice. So you deposit the money into a savings account, you leave it there, and when you find that you actually need the money, you notify the bank, listen, I would like to withdraw this money, and after 32 days, you will be able to get your money out. All right, so you still have to give notice. It's not like you can get your money tomorrow, but you don't have to wait for the 5 years that you've invested the money for, like in the case of a fixed deposit. All right, so a 32-day notice account, your money is more liquid. Now it's easier for you to withdraw your money again. Right, now with a 32 days notice account, you earn more interest than a normal check or savings account, okay, but less interest than a fixed deposit because it is more liquid. All right, the minute that the bank knows they're going to have your money for 5 years, they know that period is fixed, they're going to offer you a higher interest rate. With a 32 days notice account, they don't know at any given point in time. You can give them notice that you want your money back. All right, so they are not guaranteed of the period for which they have your money and they can use your money. So because of that, the interest is less. It is still more than a check or a savings account, but it is much less than a fixed deposit. So the return on your investment is not as high as what it would have been if you made a fixed deposit. All right, the interest rate again is fixed. It's still not going to change during the period of your investment. Okay, the risk, once again, because you are making an investment in a bank, you are making a deposit into a bank account, same thing as with the fixed deposit, it is low risk. You are almost 100% guaranteed that you will get your money plus interest back. All right, it is almost guaranteed. Right, in this case now interest is calculated on a daily basis. So every day they look at the balance in your account and they calculate the interest on your daily amount, which means that you are getting a faster return on your investment and a lower risk. All right, again, the interest rate is fixed. So again, it is not influenced by fluctuations in the market. All right, so again, once you have agreed on that interest rate, that is the interest rate that you are going to be receiving for the duration of your investment period. Nothing that happens in the market is going to change that. So again, if interest rates are dropped by the Reserve Bank like they are doing now, your interest is still going to stay at the higher rate because that is what was fixed at the beginning when you made the investment. Your interest rate cannot change. Right, the next investment opportunity is debentures. Right, debentures is a document or an investment opportunity, investment instrument that is issued by businesses to raise borrowed capital from the public. So in a business, instead of borrowing money from the bank, they can issue debentures to members of the public, which means then that they are borrowing money from members of the public. All right. The lender or the debenture holder, the person, the public person, the member of the public, agrees to lend money to the company on certain conditions for a certain period of time. So for example, if a company sells me a debenture, I am the debenture holder. I am basically borrowing my money to the business. I give them my money, I get a debenture certificate, and they have my permission to use my money for whatever purposes they need it for a certain period of time. Okay, the period would be indicated on the debenture itself. So if they sell me a debenture for 5 years, that means over 5 years' time, in 5 years' time, they're going to give me my money back. But in the meantime, they can use my money any which way they see fit. All right, so I'm basically lending money to the business. So I am a creditor of the company. Now, the company that sold me the debenture, I am their creditor. They owe me money. They are using my money. It is my money, and they have to pay my money back at the end of the debenture period. All right. These debentures can be traded on the JSE, right? So if a company needs to raise borrowed capital, they're borrowing money, they can sell debentures on the JSE. Just remember the difference between debentures and shares. As a shareholder, you are owner of the company. As a debenture holder, you are a creditor of the company. All right. If they sell shares, they are raising their own capital. If they are selling debentures, they are raising borrowed capital because they have to pay it back. All right. Right, debenture holders also receive interest payments based on the amount of debentures held. So obviously now if I have a debenture, every year the business that is now using my money must pay me interest. Same as what they would have paid from a bank. If they borrowed money from a bank, they would have paid interest. So now they're borrowing money from me, so they are owing me the interest. Yeah, that is why for me it is an investment. They get my money, I get my money back, plus in the meantime, every single year I am earning interest. So this interest is the return on my investment. My money is growing. They keep my capital amount, but every single year I will earn interest based on the amount of debentures, the amount of money that they've now borrowed from me. Right, the risk is also, it's relatively low risk because debenture is a contract. They have to pay me back after the 5 years or 2 years, whatever is agreed upon when the debenture is sold. There's a period. After the end of that period, they have to pay me back. There's a contractual agreement that they're going to pay me back. Right, and also they're liable to repay the amount of the debentures plus the interest. Okay, as I said, if I borrow them 5,000 Rand for 5 years, every single year I am going to be earning my interest, passive income. And after the 5 years, they are also going to give me my capital amount back. So I get my money back plus interest. Right, so investors can earn a steady income in the form of interest while preserving their principal amount. Every single year, for the amount of years that they get to keep my money, every single year I am going to be receiving interest. It's that passive income. I'm earning income and I'm doing nothing. I'm literally doing nothing. I gave them money and I'm sitting at home and I'm doing nothing. And I'm going to receive this interest every single year. Right, if we look at venture capital, right, venture capital is given by an investor for a business when a business is started up. All right, so if I want to start a business, but I don't have enough capital to start the business on my own, I am going to approach other people and I'm going to ask them if they would like to invest in my business. Right, so if they say yes, fine, they will give money to invest in my business. In return, I'm going to give them shares in my business. All right. So venture capital is the money that is used or that is given by investors to help with the starting up of a new business. And in return for that, obviously they're not going to give me their money for nothing. In return for that, I'm going to give them shares in this new business. All right. Now, obviously, if you are going to invest in a new business, you need to know the type of business and the economic conditions before a business is started. Obviously, venture capital, the risk is there, right? Because it is a new business. You do not know if this business is going to be successful or not, right? So there's a lot of research that has to go into this. Right. If you look at there's a program on DSTV. It's called Dragons Den, right? Where potential entrepreneurs approach wealthy people to see if they would like to invest in their businesses, right? But obviously, before you as an investor invests in somebody else's business, you are going to want to know how much research has gone into this. What kind of product are you selling? What is your projections of sales over the next 5 years? Where's the money going to come from for X, Y, and Z? Where are you going to find your workers, right? You are not going to invest in an unknown business without doing loads of research, right? Economic conditions of the country is also important. Right now, for example, South Africa is in a recession, heading into a depression possibly. So to start a business now would be madness. All right, no investor is actually going to invest in a business now because the times are too uncertain, the economy is too uncertain. Businesses are going to close down, not open up. All right, so lots and lots of research is needed by the investor before he's going to be willing to invest his money in somebody else's business. Right, buying a franchise or an existing business, that can obviously be a little bit less risky, but still you need to do your proper research. All right, if you're buying a franchise, for example, a Wimpy or a McDonald's or whatever, those are franchises. Obviously, those have been established for a while. They have a reputation. They've got a track record. It is less risky, but you still have to do your research. All right, where is this business going to be started? The person starting the business that's now wanting you to invest in his business, is that person trustworthy? Is that person hardworking? Right? Lots of things that you have to think of before you do this. All right, as I said, this is a high risk investment. You are investing in a business that doesn't exist yet. Nobody knows if this business is going to be successful or not. This is a very high risk business. Right, inexperienced business owners can also make wrong decisions, business decisions, that can obviously have a detrimental effect on the success of this business. If the business owner that's now asking you to invest in this business, if he makes a wrong business decision because he doesn't know what he's doing or whatever, and he analyzes the data wrong, that can cause the entire business to close down. And then you as the investor, you're going to lose every cent of your money. Right, very high risk investment. Okay, if we look at the life insurance policies or retirement annuities, okay, this is where you make a monthly payment to an insurance company with the expectancy of receiving a predetermined amount on a certain date in the future. All right, so for example, when it's a life insurance or whether it's retirement, right? So if you've got a life insurance policy, basically every single month you pay them a certain amount of money with the idea that one day when you die, a specific amount of money is going to be paid out to your dependents. All right. Or in the case of retirement annuity, every single month you pay a predetermined amount. Every month you pay. And when you reach retirement age, 60, 65, or whatever you decide on in the contract, a certain amount is going to be paid out. All right. So every month, starting from whenever, obviously, the earlier in your life you start making your monthly repayments, the bigger the payout is going to be when you're 65, right? But every single month there is a contract. There's a contractual obligation that you have that every single month you are going to pay your premium. You pay a certain amount of money. And then when a certain event happens, okay, it can be in the case of death, it can be when you reach a certain age, then the policy will pay out and you are going to receive whatever amount was agreed upon in the contract when you took out this policy. All right, the whole idea is it's a saving. Okay, this is also saving. You are providing for your future expenses. Okay, so when you retire, obviously you are no longer going to be able to earn an income. So you're going to no longer have a salary. So the idea with making contribution to retirement annuities is that when you are older and unable to work anymore, you will have money to survive on to satisfy your needs. Now you are providing for your future expenses. You are ensuring that one day when you retire and you can no longer work, you will have money to meet your needs. Or in the case of a life insurance policy, should you pass away, you know that the money will pay out and your dependents, your wife, your husband, your children, will be cared for. All right, there will be money for them to actually live from. Risk is very, very low risk. Now, insurance companies are also financial institutions. So there's very strict laws and regulations that they're governed on, right? So also the chance, and it does happen, I'm not saying it never ever happens, but the chances of an insurance company going belly up and people losing their money, it is small. It does happen, but it doesn't happen often. All right, it's a very low risk option for you to invest your money in because you know that amount that you have agreed upon in the contract will be paid out when you reach that certain age or when you die. Right, literally, the only risk that you have is bankruptcy of the insurance company. Right, so literally the only thing that can go wrong is if the insurance company goes insolvent and they are closed down. And as I said, it does happen, but it's sure as hell it does not happen often. All right, your unit trust is the next investment option. Okay, unit trust is a collection of investment options or methods made up of shares in different companies. All right, so how a unit trusts work? Again, you are going to appoint a fund manager that works for some recognized company, and that person, you are going to pay him a certain amount of money every month. Okay, every single month, you are going to give him a certain amount of money, and it is up to him where he is going to invest that money. All right, that investment manager, he can take the investments of more than you. Okay, you contribute a certain amount per month. He takes your money together with other people's money and he puts it together in a unit trust fund that he then manages. All right. Now, also, once again, you have appointed this fund manager. So you have given this fund manager to do whatever he thinks best with your money. All right. So if he is going to invest them in shares, then so be it. It is up to him where he is going to invest your money. All right. So it can be bought directly from accredited service provider, Sanlam, Old Mutual. Those are companies that normally sell unit trusts. They're recognized, stable financial companies that have fund managers or portfolio managers that is working for them, and you pay your money, you sign a debit order or you pay them cash every month. They take your money, and as I said, they take it together with other people's money, they put it all together and they invest that money as they see fit. Right, the risks. Right, now when they pool your money together, they are not going to put all the money in one kind of investment. Okay, so they're not going to invest in one type of share. They're going to take your money and they're going to buy different kinds of shares. Sometimes they're going to take some of your money and they're going to invest in shares where that carries a high risk, but other bits of your money they're going to invest in low risk shares, which once again means that you are not putting all of your eggs in one basket. So because they are buying different shares with your money, some shares are going to be doing well, some shares might not do as well. But all of your money is not invested in one type of share that if that one type of share does badly and it bottoms out and the value plummets, you lose all of your money. You still have some of your other money invested in other shares. Okay, so the risk is spread out. All right. Fund managers are also able to manage the risk level, okay, because obviously, once again, they are experts. They have been trained. They know how to read the markets. They can make fairly accurate predictions about what is going to happen. And because, as I said, they don't invest all of the money in one thing, they are spreading your risk and they can move your investments around if they feel that some of the risks are too high. They sell those, they buy something else. Okay, then if we look at shares, right, now a lot of this information on shares we are going to repeat again, so I'm going to go over it now very quickly, okay, to explain what is an ordinary share and what is a preference share. That is a whole lesson on its own later on in this chapter, okay? So I'm physically just going to teach the content on here now. We will do the details of the share when that lesson comes. All right. Now, when you invest in shares, that means that you are buying a portion, a part of the ownership in a business, in a public company. All right. So any public company can sell shares on the open market at the JSE to obtain capital to operate their business. All right. So if a business sells shares on the JSE, they are basically selling ownership of the company. If you buy a share, you become a part owner of that company. The money that you pay for those shares becomes part of the own capital of the business. The business is raising money. Okay, for example, if they want to expand, they want to build another factory, all they do is quickly they sell another 100,000 shares. 100,000 people buy shares. They take the money that was paid for those shares and they can actually build another factory. All right, so they use the money that they gain from selling shares to operate their business. When you are a shareholder of a company, each one share that you own gives you one vote at the AGM. All right, so every year the company must, by law, have an AGM. So if you attend that AGM and a vote needs to be taken on who to appoint as managing director, or are we going to build another factory or not, or are we going to add another product to our product line, every shareholder has a vote. One share, one vote. So obviously the more shares you own, the more votes you have at these meetings. And also, if you are a shareholder, it also gives you the right to receive a dividend. Now, at the end of the financial year of that company, when they make a profit, if they make a profit, and if they declare a dividend, you will receive your share of the profit. A portion of that profit belongs to you because a portion of that company belongs to you. Right, companies do not have to repay share capital. All right, so from a company's point of view, when me as the investor, when I am buying those shares, that money, it now belongs to the company and I cannot get that money back. All right, the only way I can get my money back is to sell my shares to somebody else. All right, and the company itself is not going to give me money back for my shares. All right. As I said, the shares of any listed public companies, only public companies, can be listed on the JSE. So anybody wanting to buy or sell shares can do so on the JSE. Right, shares can be bought and sold through stock brokers. So on the JSE, it is 100% possible for an individual to do it himself. Okay, you yourself can physically buy and sell shares on the JSE, but it's always better to work through a stock broker, because again, those stockbrokers are more knowledgeable and they can advise you with regard to which shares are the good ones to buy and when is obviously now the right time to sell those shares. Now, they have been trained, they know how to read those markets, but obviously if you go through a stockbroker, he is providing a service, and when he provides a service, he needs to be remunerated for that service. So a brokerage fee will be paid. All right. So it is going to be more expensive for you to buy shares through a stockbroker or to sell shares through a stockbroker, because he is going to take his brokerage fee, his payment. Right. As I said, we get different types of shares, and different types of shares have different claims on profits. They have different voting rights, and they have a different claim on assets in the case of liquidation. Right, we are going to look at this later. As I said, we have ordinary shares and we have preference shares, right? Different shareholders have different claims on the profits. Okay? So depending on the type of shares that you own, that will determine what your claim on the profit is, whether you have a right to a dividend or not. Okay? Certain shares have voting rights. Ordinary shareholders have voting rights at the AGM. Preference shareholders don't necessarily have voting rights at the AGM. All right. In case of liquidation, for example, if you're an ordinary shareholder, you are most likely not going to get your money back. Preference shareholders do have a small chance that they might get their money back, the money they paid for their shares, in case of liquidation. But as I said, we are going to look at this in detail in the next lesson. All right, when we look at the ordinary shares, we get different kinds of ordinary shares. They're divided into your blue chip shares, bonus shares, growth shares, income shares, and defensive shares. And your ordinary shares, as I said, they have no special rights or restrictions. That's what ordinary means. Ordinary means like everyday ordinary. There's nothing special about it, right? So there's no special rights or restrictions attached to them. They may yield higher dividends. Okay, so in certain cases, they will earn a higher dividend than a preference share, but their risks are higher. Okay, that's why the dividends is higher. Remember, we said high risk, high return on investment. Types of preference shares will include cumulative or non-cumulative, participating or non-participating, redeemable or non-redeemable, and then convertible or non-convertible. What all of this means, it follows in the next lesson. Your preference shareholders mostly will receive a fixed dividend and normally will be paid before your ordinary shareholders. But once again, we will look at this in detail later. Right, shares, to invest in shares, have a low or medium risk over the longer investment period. Over the short term, it is very risky because it is volatile. Now, anything can happen. Increases or decreases can happen all the time, anytime. Ordinary shareholders have the highest risk, okay? And this only comes in when the company is liquidated. All right, so if you have bought ordinary shares in a company and that company keeps making losses and eventually the company closes down and it is liquidated, as an ordinary shareholder, you are last in line to receive the money that you have invested when you bought the shares. Whatever you've paid for those shares, you are probably not going to get back. All right. If a company is liquidated, it means they cannot meet their obligations. So first of all, creditors are going to be paid. Then the preference shareholders will be paid. And lastly, if there's money left, the ordinary shareholders might get some of their money back. Okay, as I said, preference shareholders' risk is lower because if the business is liquidated, they will be paid before the ordinary shareholders. All right. It is also not guaranteed if the business is liquidated and they have had lots of debts, the first people that are paid are the creditors. And if there's not even enough money to pay the creditors, your preference shareholders will also not get anything back. All right. But if creditors are paid and there are still money left over, preference shareholders will get payment before the ordinary shareholders. So they might get some of their money back. All right. In yesterday's lesson, I also did mention that the value of shares, the prices that we pay for shares, are linked to factors that investors cannot control. That is what makes it risky. We cannot control what happens on the market. Economic conditions, right? If we are in a recession or a depression, if we're in an upswing or a recovery, that will obviously impact on the value of those shares. The success of the business. If certain businesses' share prices are higher than others, your more successful businesses, your more profitable, stable businesses, obviously their share prices will be higher than businesses that is not always as successful. And the minute that a normally successful business makes a loss, immediately their share prices will fall also. Right, and as I mentioned earlier, share prices are very volatile. It is totally unpredictable. Share prices can increase or decrease within the question of hours, minutes, depending on what is happening on those markets, right? So over the short term, it is very volatile. There are huge fluctuations, increasing, decreasing all the time. It is more stable over the longer time. Okay, that's why the risk is so low in the short term, because of that volatility and those sharp increases and decreases that we cannot predict. Right. I think this is the last option that we are looking at. So the RSA retail savings bonds. Okay, this is offered by South African government to South African citizens. Right, if you are investing in savings bonds, you are basically buying a savings bond from the government. All right, two different bonds are available. Okay, you can choose if you want a fixed rate bond or an inflation linked retail bond. All right. So when the government are selling bonds, basically, again, when I buy a government bond, I get obviously the bond certificate, right? The government takes my money, and again, the government is free to use my money for whatever they like. They can use my money for anything, all right? But after the period, the maturity date, the money is going to be paid back to me. Whatever money I've given to the government to buy this government bond, when I get my money back, obviously that is almost guaranteed. All right. So when I buy the government bond, I get the bond certificate. The government takes my money. The government has total carte blanche. They can use my money for whatever. But after the maturity date, the government is going to give me my money back. All right. And in the meantime, obviously, I can earn interest. All right. Now, when you buy the bond, you choose, as I said, either a fixed rate or an inflation-linked retail bond. The market-related interest rate is determined when the investment is made. All right. So if you choose the fixed rate option, when you buy the government bond, they are going to tell you what the interest rate is that you are going to be earning for the entire term of the investment. So if you are buying this bond for a period of 5 years, they are telling you, right, for the next 5 years, you are going to be earning 10% interest, not that high. Okay, but let's say you are earning 10% interest for the next 5 years, and this rate is fixed. So it doesn't matter what happens in the market. Okay, when you buy the bond, you decide what that fixed rate is going to be, and you are going to be earning that interest for the rest of your investment period. All right. Obviously, whatever they fixed your rate at will be determined by what the interest rate is at that time. Okay. If you choose this option, okay, whichever option you choose, interest is earned twice a year. Okay, any other investment, any like the 32-day account, whatever, the interest is calculated differently, right? So with a retail savings bond, you are earning interest twice a year. Fixed deposit, remember, once a year, right? So every half year, on 31st of March, you will receive the first half year's interest, and then on the 30th of September, you will receive the second half of the year's interest. And this interest is paid into your bank account. All right, so it doesn't accumulate, right? They keep your principal amount, but every 6 months they pay you the interest that is due to you. So it is also a passive income, right? You are sitting at home doing nothing, and every 6 months you are receiving your interest payment. All right, one disadvantage of a savings bond is that it cannot be used as security to obtain loans. All right, so your creditors cannot have any claims on it. All right, life insurance, for example, if you borrow money to buy a house, for example, the government, the bank asks you to give something as security. You normally have to give them your life insurance policy so that if you do die and the life insurance policy does pay out, your family don't get the money, the bank gets your money to pay off your loan, and if there's money left, they give it to your family. Now, this cannot happen with a retail savings bond because it cannot be used as security. All right, you cannot use it as security. You cannot use it to obtain a loan. All right, so your creditors cannot take your money if something should happen. It can, however, be inherited by a nominated beneficiary when the investor dies. All right, now one thing, pensioners like investing their money into retail savings bonds because it is so safe, okay? But obviously pensioners are older and they are a bit closer to the date of dying, right? So if you have bought retail savings bonds and you do die, your savings bond will be transferred into a nominated person, right? When you buy the savings bond, you are going to nominate a person. Okay, I'm going to say, right, if I die, I want my money to be paid out to my children. All right, so you nominate a person to receive the money should you die before this money is paid out. Okay, so your beneficiary will receive the money in that case. All right, as I said, pensioners like to invest in retail savings bonds because they are so safe. The risk is extremely low because the investment is made with the government. The government cannot disappear. Sometimes we wish they will, but they don't. They do not disappear. They cannot go bankrupt. All right, and even if we have another election and a different political party becomes government, your contract is with the government, whoever is government at that point. All right, so you are 100% guaranteed you are going to get your money back and you are going to be receiving your interest. It is the risk is almost non-existent in this case. All right, so okay, as I said, it's a safe investment. It cannot be sold on the open market. It's not exposed to market risks. It cannot be used as security. Your creditors have no claim on this. It is a 100% safe investment.